All right. Good evening, guys. Ken at Tortoise Capital. This is the nightly strategy podcast for September 23rd, 2020. Today, the floodgates opened, and all the psychobabble that I've been doing on the market conditions and doing different strategies and contingency planning and rehearsals for the market really kind of paid off in spades today. So I'm going to stop apologizing for market commentary. Yeah. Here we go. All right. So let me get my little pen going. Let's see what we got here. Okay. All right. So let's take a look at what we got. So this is the market on the daily. And, so what we've seen now is a 10-day high. This had previously been the 10-day low. And that had been the peak high. So we had this kind of big fat move here. And so each of these little pivot points are like critical states, right? Because in either case, this could have gone up or it could have gone down. I mean, it went down. We can see that to a new 10-day and a 30-day low 2 days ago. So this was a critical state that could go up or down. This one, after that big move from plus Z2 to minus Z1 and a new 10-day low, this one could have gone up like it did, or it could have gone down. It chose to go up. When it came to here, came back and tested. Should probably make that a big fat pen. Oh, much better. So now that makes this kind of a critical state right here. Is it going to rebound and go back up here? Or is it going to break this previous low and then this whole thing becomes a collapsing dragon? Well, we can see what it did. It did that. It came down and made a new 10-day and 30-day low. So then it rebounded. So this becomes a critical state. It could rebound like it did and come right back to this resistance, what had been support, but is now resistance until proven otherwise. A 2-day pop led by tech. Remember, we said tech was strong on both of those days, but almost nothing else. In fact, because we saw XLB, materials, energy, and finance all had gone down, and the only thing that was working were the key leaders in tech. And so when they've had a nice 2-day move from 320 and pull the market to like 332, which is about a 4% move, how much more is still left in there, we wondered? Or was that just a technical rebound? And if tech isn't there and nothing else picks up, then there could be a sell-off. So what we had been doing was mapping. I wonder if there's some I can do all of the. Oh, that erases everything. That's stupid. Yeah. So we had mapped out the dragon, and I'm going to draw this as a big fat orange crayon. So as we were watching this move of the dragon, when he rolls over, that really becomes significant, right? When it first rolls over, there's more volatility. So notice how wide that dragon gets. And when it is moving up in a tight range, that dragon gets very thin. So he's starting to get wide, and that's part of that volatility. So as we continue to watch that move down here, here's kind of the scope of our dragon, right? So that dragon is really pointing the way down. And from this low, we watched 1 day up, 2 days up, and now it's coming into this boundary. Is it going to get through the dragon? Is it going to get through this, this 30 period declining regression line? Is sort of the health of the market. We saw that 30 roll over like this. So that thing has been a solid indicator of the health of the trend. So that RL30 was like this. This is where it came back into the river. This is where it peaked. This is where it crossed the Bollinger Band mean. And this today is where that thing crossed out of the southern shore of the river. So now when the RL30 departs the river, that's the beginning of trending behavior to the downside, because now you have price, the RL10, and now the 30 has left the river. This is now officially downward price action. So as long as that RL30 is just going to keep going down, then the health of that trend is down until someday it will rebound. And then somewhere around in here, when it does finally rebound, I don't know what'll happen right there, but wherever it does, that reversal is the fifth criteria in the owl. All the other price action would have had to improve. And finally, when the RL30 turns and makes that little bottom and starts to roll back up, that's the sign of the owl. In the same way that when the RL30 peaked up here and rolled over, that was like an owl entry going short. And so all of this price action has been reinforcing that move from about here all the way down now to here, which is a move from about 347 all the way down to 322, which is $25. $25 on a base price of, call it 350, is 2.5 out of there. So that's about 8%, I guess. So you capture a really nice, this move from here to here is what's baked into the cake when you see that owl finally roll over. Well, now what we're tracking is we've got this PSAR flipped right here too. There was the PSAR all the way up, and then this price action rolled over, and then finally the PSAR flipped. So the distance between those two PSARs, you can even think of that as like a noise barrier. Finally, if this thing has to get through this upper barrier, the peak of the RL10, for this thing truly to be a resumption of that previous bull. The previous bull brought it all the way up to the top. Now there's all this corrective price action. So it still has to get above 355 to be free and clear. And this will be the final band of resistance to the upside. But now this resistance is big here because it came down, peaked, and fell. So the bottom of this one the bottom of this resistance band has already rejected here. And this came down further, bounced, and now came down again. So the southern skin of the dragon, the whole dragon region, the Bollinger Band mean is going to be coming down. The RL30 is down. These PSAR dots are just going to keep following this line down. So the longer this thing goes down, the more all of this price action becomes another thick layer of resistance that this price has to penetrate to get up past 355. I wouldn't hold my breath on that one. So that's kind of that. So now you just notice that that entire move up, whoops, that entire move up this wall of worry that we climbed, you know, this is where the RL30 came out of the river. And so that whole time from here all the way up to here to where it peaked, that was that upward trend riding between Z1 and Z2, all of that price action, on the way up, guided by the supporting dragon and the whole PSR dot. So that's what it felt like on the upside. And that's why these turning points are kind of so crucial. Now, being able to see when the RL10 crosses the baby dragon, enters the dragon, crosses the spine of the dragon, the RL10 leaves the dragon, that is your RLXD, regression line crossing the dragon. That's huge. That makes this the short signal. Here's the RL10 crossing the Bollinger Band mean. Here's the 30 crossing the Bollinger Band mean. Here's the RL30 basically leaving the river. It'll be tomorrow. All right. So that's the beginning of trending behavior to the downside. So what we had today was a close here yesterday, as we are now, you'll notice we're in the winter. Here's where that fall became winter. And then when winter rolls over, bang, right there. You find that bottom of the RL10. And when price collapses through there, yes, my friends, you have a collapsing dragon, which just on those 2 days went from 332. It gave you this move and this move, 332 to 322. That's a 3% move. That's why the collapsing dragon is your friend. This one never even got above the dragon. This is where you might be thinking about the supported spring crossing if price had been able to come up here, but it didn't. That RL10 rolled over, collapsed, and that's why this is a collapsing dragon right there. So then it came down to the Z3, made that new 30-day low, and this is a combination of a 30-day low and a 10-day low, still barely above long-term fair value, that 270 regression line. And then from that oversold condition, you'll recall everything was on a channeling and overreaction. So you get 1 day rebound, 2 day rebound, but now it runs right into this dragon resistance. And so it closed here yesterday, opened here today, and then did nothing but that. Big time collapse. From 330 to 322, that's minus $8 on 330. That's about minus 2.5% in 1 day. So that's greater than a 1 ATR move, all directional. And notice that right from the open, that thing became directional. So when this is the argument for the hybrid frog, right from the open, so that should actually be the color blue, so when you have an open, that's here, wherever it closed here, and then it opens here, and we put that little minimum manageable risk box around the open, and we're ready to go this way if it breaks out to the upside. We're ready to go that way if it breaks down, and in here we have that minimum manageable risk box, and whichever way it goes. So it broke down south, so down we go. Then that trailing stop, either that full box or you just take half the box and start trailing it until you can lock in no lose plus dinner for two, and then it's a science project, and you can see that you end up getting short right in here on that hybrid frog. And then right about there, you get to no lose plus dinner for two. And now this is just a science project to see what you can capture. And you get a huge payoff for a small risk. And you get this large directional day, which was greater than 1 ATR. So just on its own merits, just by using a daily or even an hourly chart, you get some amazing moves. And you can say, when it breaks down below yesterday's low, that's a place where you could even add a second position. So you got one position here, two positions there, and now that thing really pays off. By the same token, tomorrow, if this thing breaks down below that 30-day low and 10-day low, am I going to be short? Yes. Yes, I am. And my targets are going to be fair value, Z3, and beyond. So this is that's what another ATR move looks like. That looks like about 314. So 314 is in play tomorrow. And if we just play that fractured support level, it'll sound like a wood beam cracking under too much weight, an elephant walking in a bamboo house, and down it'll go. That's easy to believe too, because this is the 10% sell-off right here, the bottom end of this thing. This is that's about a 15% sell-off over here. This is marked off as the minus 15% from the swing high, so 303. So this 10% sell-off at 321 is where the conventional wisdom says that everything after this is more than just a correction. And so there will be an extra sense of emergency and surprise heading south, right? So that makes, 314 is halfway down to another 5% sell-off. So this is going to be fireworks tomorrow. Because if tech sold off today, who thinks that materials, energy, and finance are going to step in and save what tech couldn't save? Who's going to bet? Who's going to bet that way? What you may see is if there is a turnaround tomorrow, it could still very well be tech, right? Because Tesla is now trading at 380, and I bought a position in Tesla today for my kids. And Twitter was plus 6% today and broke out to a big time new high. So those two little guys, modern tech, could be part of this story tomorrow. So strength tomorrow could come from tech or just from SPY being oversold and IWM, the Russell. SPY and IWM could be guys buying the broad indexes on sale. So rather than buying a targeted sector, there may be some buying pressure just because the indexes are so dramatically oversold. And, there's a justification. We're around Z minus 3 already. So that is legitimately an exaggerated move to the downside. So we could certainly see something amazing to the upside. Okay. So that's what I want to say about that. I just want you to, recognize why I spend the time on the market, because that's worth 50% of the daily moves of anything else I'm interested in. So if I get that right, I'm in the neighborhood, and if I don't get a dinner, I can get a sandwich. All right, so let's see what the markets did. So we had the S&P at minus 2.5. The thing, let's see, the diamonds were minus 2. Treasuries were plus 0.13. The Russell was down 3.3. So really, the more defensive plays, the defensive treasuries, the more conservative large caps, the broad market itself, and then the speculators, the small cap U.S. Traders, the shorter term traders, were much more interested to the downside. So let's look at the downside first. So the S&P down 2.5. The FANGs down minus 2.8. So that's Facebook, Amazon, Apple, Netflix, Google. So the new tech down even worse than the S&P. That's not good. Materials, broad tech, and Mexico down around minus 3 to minus 3.2. Brazil down 3.5. Clean energy 3.5. Energy itself minus 4.5. Oil exploration minus 5.25. Silver minus 7. Silver and wheat and precious both cracked today. And then the triple techs down minus 9.5%, TQs and TECLs. And then even our old buddy Tesla and Nikola. Tesla down 10%, Nikola down 25%. Rocket sled on that one. And so I bought some Tesla near the end of the day, around 380 and some change for the kids, because I got about a 30-year time horizon on that for them, so why not? If it goes to zero, I'll be dead by the time they realize what I did, so that'll be okay. Unless my son comes up with this damn cyborg body and infinite permanent brain that he's working on. He's burning a lot of midnight oil on his dissertation, so I think that's what he's working on. All right, so some of the companies that suffered more than the S&P today, and these names are reasons why we should be really concerned about the losses just beginning. Leading contenders like Facebook and Intel and Home Depot, Cisco, Goldman Sachs, which had been the strongest financial, Microsoft, Simon Property, Google, Boeing, U.S. Steel, another 3.5% down. NVIDIA, Amazon, Apple, Safe Search. What? God dang it! That Salesforce. Sierra. I'm going to remember that name someday. Salesforce. Wheaton Precious, Devon Energy, a disappointment there, 5.5. And then Tesla and Nikola all getting smashed. And you'll notice all these red dots, that's everything, pointing to that's the daily winter. So when I look, these are the 4 seasons here. So you got daily winter, daily spring, daily summer, daily fall. So you can see the preponderance of things that are in the winter. There's only a couple things that are in the summer, and that's treasuries and Twitter. And there's a few things still in the fall that haven't quite broken below zero yet, but there you are. So that, again, the preponderance of red tells you that's almost a market classification in that sense. So that's how important I think the 4 seasons. So there's the daily winter, spring, summer, fall. I'm always interested in things when they become weekly spring and weekly summer, because that feels like the turning points. Weekly spring is like the turning point on that higher time frame. So I'm catching them early in the move off the bottom. And then weekly summer is that kind of positive follow through on the longer term. So that those are the 2 weeklies that I follow. And then same thing, monthly spring and monthly summer. So I like that treasuries are monthly summer and daily summer. That's nothing but good news. Yeah, so that actually feels pretty good. That's Treasuries coming up for you on the daily here in a minute. Yeah, so that's the daily on Treasuries. That does not fill me with worry. So you may recall the the move back in July to lock in the core positions, shifting those out of equities altogether. I was hoping this would show for me. It's not. Okay, so we'll head back. All right, so we're going to shift back now to the sector analysis again and see what we come up with. So treasuries are feeling more and more like that store of value, and the last refuge of a scoundrel going into the election period. So things that were better than the S&P today, the sectors. So finance was marginally better, minus 2.25 instead of 2.5. Then a cluster of consumer discretionary, emerging markets, the Ackman hedge fund, healthcare, and oil between minus 1.5 and 0.5. Into the green, wasn't much. It was treasuries at 0.13. Japan is a store of value at plus 0.6. The VIX 5.25, and then Twitter plus 6%. So that was the anomaly today, right from the open when everything else was getting slaughtered. Twitter was getting piled on and getting piled into. So that's what I want to look at now. So this is Twitter on a daily. Let me let that come up for you. So Twitter on a daily, we had been noticing this strong support around 39 and 40. And then the dragon rolled over and it went from winter back into fall and summer. And so we got a swing entry in this thing at 40.5. And then that was also a hybrid frog that morning. And so that hybrid frog paid off really well and paid to keep that swing. So we carried, 1/5 of the intraday trade from yesterday. Got a favorable overnight gap, and then with a hybrid frog box, so we'd be looking at something like this. So when you put that hybrid frog box on there, you're ready to go. You're ready to follow it north or south out of there. In this case, it went north, and then we were able to trade in that direction from 43.8 ish all the way up to 47. So that's almost that's about 7 to 8% from from the open to the peak, and then it gave back enough so that it netted 6% from here to there. So Twitter was the big anomaly. That's clearly people interested in Twitter with big money moving it around. So the point I want to make here is that the daily gives you reasons to be in this thing as early as here. Then when this gaps up to the previous Z3 and starts taking off, there's even more reason because you've cleared all the resistance. You're beyond Z3 and going with power. That's a no-brainer. It just is. And here you have the PSAR flip had already happened from yesterday's big move. So the PSAR flip has moved. The RL10 is in summer, and it closed pretty well, and it closed outside the Z3. So I kept the same piece of the swing trade that had been paid for, but I didn't hold a big position in this thing. I sold 80% and made bank on it. But I'm going to be ready tomorrow with another hybrid frog box, wherever it opens. And so if it opened right where it closed, I'm just going to have a hybrid frog box, and I'm going to be ready to trade that north or south, with about a 30-cent initial risk, something like that. And just off we go. That trade on the intraday now looks like this. So we have a nice gap up. I'll wait for that to catch up. So we have a nice gap up from yesterday. You see how the VWAP moves up, and we get our entry around $44 with a 30-cent initial risk. That thing moves up sharply, holds at the VWAP, doesn't fail further, so add a second position when it clears. Up, holds at the edge of the dragon, starts resuming when it clears. Third position. Now this one gets all the way out to about Z2 and gives us a 1, 2, 3. So I take that exit there and make bank on the first three. And so that's on the first one, that's from 44 to 45 and a half. So that's $1.50 on a 30-cent risk. So that's a 5R. This is about 2R, and that's 1. So that's about an 8R first wave, while the rest of the market is getting crushed. And then it holds here, and it holds here at the VWAP, and I buy the supported fall crossing with my usual stop here. It never even, gets above my entry with the PSAR till out about here. But this one felt like it was going. So added a second position here, and now I'm using the PSARs and just exit. So that picks up another couple R. Then this one was a fractional. Didn't really follow through. There were some other messing around trades later in the afternoon, but I was decisively engaged on the next trade. So this is the Twitter speculation. This whole piece is about 10R. And then the one that really paid is this one. And this is the one that you should print. So when the Twitter trade had basically run its course, let me see if I can move this out of the way here so we can see what time we're at. Oh, there we go. So this is now the afternoon trade, right? So we're out of the lunch and it's 1 p.m. So when the Twitter trade had come into the station, the diamonds came into the sideways quiet channel. Now we're below the VWAP. So there had been weakness all day already. And then this thing comes into sideways quiet channel, then a Z3 pinch. Right up in here, this thing is a super pinch because you have the abnormally tight pinch on the Z3 lines, and then you have the RL270, the RL90, the RL30, and the RL10 in a sideways channel that is abnormally pinched, and then all four regression lines are right there. Are you kidding me? That is a super pinch, and when this thing breaks down below the pinchiest part of Z3, bang, with a 40-cent risk box at the PSAR in the usual way, and then all this thing did was just run south, and the Bollinger Band mean was never even threatened. Manager, never even threatened. So by this time, we're about 2 or 3R in hand already, and it was like a mini collapsing dragon when it fell below. So just add a position, fell, and even these little rebounds barely penetrate the dragon, if at all. Get nowhere near the Bollinger Band mean. So add a third one, big collapse. Then this sideways channel here collapses to the downside. I wouldn't be offended if you did it here, but this one felt even easier. So there's a fourth position, and then a big runoff coming into, now there's 45 minutes left in the day, and there's your PSAR sniper exit, and that's what those four positions captured. 27 R and some change, just because I saw this move from here back to I just gave it a try and nothing. So just said, all right, enough. It's 3:30. That's enough for the day. So that was having my undivided attention this afternoon. So that's how you do that. That's what I want to say about today's trade. That is absolutely nothing more than standard work for abnormal conditions. All right. So when you have normal conditions, oops, let me see if we can get this going. So when you have normal conditions, and I want to call that, let's just call that like Z2 to Z minus 2. So you have, price just kind of mucking around inside here. And there's maybe the Bollinger Band mean. That's normal conditions between the Z2s. And so standard work inside there is you find this lower low and a higher low, and so you buy that like a supported spring crossing or supported spring crossing, and then you're trying to play for this move right there. And you are respecting the fact that a Z2 is a normal place for this thing to roll over. So standard work for normal conditions is kata number one, or the owl, or whatever it may be, and or rising lows. So you buy that supported fall crossing or summer crossing or something like that. But when things get out there beyond Z2, like 2 bars, and then it starts to roll over, this is where this is now abnormal. And so standard work for abnormal is if this doesn't follow, if this doesn't continue, if this just rolls over, well then, I want to get short right in here. Right? I want to get short at what the edge of what was previously resistance, and it peaked up like a gopher and then run into the bottom. I want to get short here. So that's standard work for abnormal conditions. But if this thing just keeps going and it moves like a hybrid frog box up, and that was the Twitter trade. It gapped up and it was so far outside of the normal. This was now abnormally large when the whole market was tanking, and this thing was a huge gap up and was starting to go. That made the Twitter trade easy to contend with. This one had already had a big leg down and sideways quiet channel, which became a Z3 pinch, which became a super pinch, and then became the breakout from super pinch conditions. And then it was just standard work. When do you add? Well, you add when, you get this kind of rollover and this breaks down, you get short there. When this thing rebounds but rolls over again, you get short. That's like a little mini collapsing dragon. Same thing here. When this whole sideways piece, this consolidation zone, it didn't do this. It did not go back to the VWAP. It just collapsed. So that's the magnitude of this move down. Look how far away from the PSAR, from the VWAP that this includes. The VWAP is up here around 270.5, and it closed, a full 1% below that. So we'll find out tomorrow. Is there going to be a recovery of that gap? If not, then this thing really is going to get crushed. So tomorrow's going to be a really interesting day. The point I'm trying to make here, though, just to recover the idea was. You have some range of normal, and then you have, above that you have some abnormal, and below that some abnormal. But no matter what you do, you have a rule set that says standard work for normal, and then I have standard work for abnormal. It's always standard work, and those are rules, but you got two different rule sets. And then how you define normal, and then the abnormal tells you which rule set to use. That's the nature of what we talked about this weekend on the descriptive statistics. Okay? All right, so enough of that. Let's head on back to the daily. Just see what we got here. All right, waiting on the daily report to come up on your screen. Okay, so we are still barely in bullish volatile conditions. We're about 2% above the boundary for sideways. You can see we are dramatically oversold on the cycle, the 3 weeks in a month. We are now below the 50-yard line there on the quarterly, and the 270 is even starting to scrunch its way to the downside. Risk Z is still saying it's tactically uncertain. Lots of overreactions and channelings, as you would expect. The min pains, interestingly, Intel, Coke, Microsoft, and Cisco. So you might think of that as old school tech. And then on the max pains, Walmart, Walgreens, Verizon, United Health Travelers, JP Morgan, oil, exploration, metals and mining. Heck, even biotech, XBI. It's been a while since we've seen that. There's a pair trade for you. Pepsi-Cola, 10-day max pain, but Coca-Cola, min pain. Interesting. Again, on the daily tactical, tons of channeling and overreactions in the Dow, as you would expect. Let that come up on your screen. Yeah, tons of channelings. Lots of auto framers to choose from. I guess I'm interested in Disney just because someday that'll be a good idea. United Health, interesting at 4.4 to 1. Look how many things broke down in a big way, and only Nike looked any good in there. In the ETFs, again, lots of channeling and overreactions. Let that come up on your screen. Yeah, channeling and overreactions. A ton of auto framers. Silver is a kind of a surprise. After such a long run up, this thing has really gotten smashed. And wheat and precious also got crushed. Look how many RSI 2s are at 0. That's just how bad that sell-off was today. Is it an exhaustion sell-off? I don't know, but there's a lot of things in the ETF lands that are suffering. The auto framer offers a lot, but again, I'm just going to say the same guidance I gave yesterday, and that this is a market and sector directionality right now. It's not, there's no individual companies pushing this thing around. You can occasionally see the opportunity like Twitter if you are adaptive, but I really genuinely believe this is a time to get the market call and the market direction right, and not to take on overnight risk. I mean, it's kind of tempting to have some overnight short positions, but that's another, because I was tempted. That's normally my tell. That's normally when I start worrying about the end of the bullish or the end of the bearish move. So when I start feeling like I want to be aggressively holding short swing positions, that's usually a sign it's time to get over that. So I like to make my short side money intraday when I can be very liquid and get to cash and end the position. I don't like holding it overnight. Can't sleep. Everything's in the winter on the Four Seasons. We've covered that. And then the multi-time frame NDX just reminds us just how horrible and miserable everything is. Look at all that red. And the only relief from that is doggone Nike. So that's going to go deserve some attention, because Nike, much like Twitter, was the dog that didn't bark today. That was the odd one. So I'm going to be staying with the coyote mode of master opportunist and taking the shots when I can. I think Japan and treasuries is where old fat guys like me might want to be looking for that lower risk flight to quality. Treasuries, if you want to avoid equities, maybe Japan is an equity store of value. There's not a lot of growth there, but it's not losing as much, and may actually have some upside. All right, that's everything I want to cover for tonight. You got some work to do to be prepared for tomorrow. Be directionally neutral. There is an equally large likelihood of a big move up or down tomorrow, because, again, if you think about it, what it did, what that thing did was we had a big sell-off. It moved up to the edge of the dragon, and then today just sold off sharply one more time. So it was greater than 1 ATR, true, but it's still resting right on the price level that launched a 2-day move of plus 3.5% back up to the dragon. So could that do it again? Well, it did last time this held, but that makes that second test so quickly makes this one a really interesting critical state. It could bounce this way, it could bounce that way, down to that next price level, and the least likely one would be a sideways grind. Either one of these is much more likely, just because everybody's so nervous in the service. Okay, so that's what I want to say to be ready for tomorrow. Directionally neutral. I'm going to let price pull me quickly in the direction it wants to go, and I'll keep taking shots tomorrow. So there may be some sharp reversals and everything, but I'm just going to keep firing. Made some ammunition today, so here we are. All right, guys, that's everything I got for you. Take good care. We will see you in the chat room.